Welcome back to the deep dive. Today, we're getting into something really crucial, especially if you're navigating your 20s. We're talking about understanding and mastering your money. These years, they're amazing, right? So many firsts. First, proper income, new freedoms, loads of possibilities opening up. But let's be real, it's also a time when, well, a lot of us make financial slips, missteps that can quietly impact things for decades. Seriously, decades. So our mission today, pretty clear. We're going to unpack 5 really common money mistakes young people make. We'll look at why they're tempting, how they sneak up, and, crucially, give you the tools to avoid them, to really set yourself up for, actual financial freedom, building that solid base where money works for you.
Absolutely. And stick around to the end because we've got a bonus tip. Sounds simple, but honestly, it could save you years of financial stress. Gives you that security. It's amazing how these small choices in your 20s, they just compound, don't they? For better or worse, shaping your whole financial future.
Okay, let's dive right into the first one. It's a classic trap, catches so many of us when we first start earning, overspending, and that sneaky thing called lifestyle inflation. You land that first proper job, maybe get a pay rise, and suddenly that paycheck feels like permission to upgrade everything. The new phone, maybe a better bike, spontaneous weekend trips, eating out loads because, hey, you earned it. Feels good, right? But what's really going on?
Yeah, what you're describing is textbook lifestyle inflation. Some call it the hedonic treadmill. Basically, your expenses just creep up right alongside your income, almost without you noticing. You earn more, but instead of saving or investing that extra bit, it just gets swallowed up by new wants that feel like needs very quickly. We saw this great example, someone earning, say, $30,000 a month, but spending $28,000 every single month. Their logic, oh, I'll save later when I earn more. But the thing is, every moment you wait, you lose out on time. And time is compounding's best friend. You're just running faster to stay put, financially speaking.
So relatable, isn't it? More money comes in, but the savings account kind of stays the same, like a leaky bucket you can't quite fix. So how do we actually dodge this? Plug that leak? Well, first step, budget smartly. The 50-30-20 rule is a really solid framework. Simple. 50% of your income for needs, rent, bills, food, transport, stuff you have to pay for. Then 30% for wants, entertainment, eating out, subscriptions, new gadgets, the fun stuff. And then this is key, a solid 20% for savings and paying off any debt. Second big thing, and this is powerful, pay yourself first. Seriously, make it a rule. Set up an automatic transfer. That 20% savings, it moves to a separate account the moment your salary lands, before you even see it, before you can spend it, non-negotiable. And lastly, before you buy anything significant, just pause. Ask yourself, do I really need this or do I just want it? Honestly, that little pause can save you a fortune.
It really can. And the impact of fighting that lifestyle inflation early on is huge. Every pound, every rupee, every dollar you consciously save or invest now, instead of spending it, has decades to grow. Compounding does the heavy lifting. It's not just about the money itself, it's about control, feeling empowered to make choices for your future self, not just chasing the next purchase.
Okay, so that's lifestyle inflation. Sneaky. But what about the more obvious dangers? Let's hit mistake number 2. Falling into debt traps. Credit cards, easy EMI offers, they look like magic wands, don't they? Instant gratification, that gadget, that holiday, feels like a shortcut. But if you're not careful, really mindful, they become financial handcuffs quickly.
Oh, absolutely. And it's striking how easy this credit is to get, especially for younger people just starting out, maybe without a totally stable income yet. Our sources showed many 20-somethings buying luxury stuff on EMI without really having the solid financial base to keep up those payments long term. And here's the real danger. Debt grows silently. That interest just keeps ticking up. Miss just one payment. You get penalties, maybe higher interest rates. It spirals fast, undoes any progress you thought you were making. And that weight of debt, it's not just numbers on a page. It's heavy, emotionally heavy, affects everything.
It really does. That emotional toll is huge. So how do we use these tools, like credit cards, without getting trapped? Okay, first, use credit cards for convenience, yeah, and maybe building a credit score. Not as extra money you don't have. Treat it like a debit card money you already possess. Second, and this is non-negotiable, pay the full balance every single month. Do that, you avoid interest charges completely, the card works for you, not against you. And finally, some strong advice here. Generally, try to avoid loans, including EMIs, for things that don't go up in value. Gadgets, holidays, fancy clothes. They depreciate. The thrill fades, but the debt sticks around.
And being able to consciously avoid those debt traps, it's incredibly freeing. It means you keep your financial flexibility. You can grab opportunities, handle unexpected stuff, make choices from strength, not desperation. Avoiding that long-term stress is fundamental to finding any kind of financial peace.
All right, mistake number 3. And this has massive implications for your future self. Not investing early enough. It's such a common thought, isn't it? Oh, I'll invest later when I earn more, or I just don't have enough to invest right now.
Hmm.
Investing feels like this grown-up thing for people with big salaries, not for someone just starting. But what's the real cost of waiting?
It's huge because the core reason to invest early is compounding. That incredible, almost magical power. When you invest, it's not just your initial money growing, the returns you earn. They start earning returns too. It snowballs exponentially over time. There's this brilliant example we found. Imagine investing just 5,000 euros a month starting at age 22. Okay, now compare that to someone who starts at age 30 but invests the exact same amount, 5,000 a month. By retirement, assuming a decent return, the difference in their final pot could be, wait for it, 50 lakh or even more.
Wow, 50 lakh, just from starting 8 years earlier. That really hammers home the power of compounding. And that old saying, time in the market, not timing the market, right? So, okay, for someone in their 20s, or maybe someone listening who wishes they'd started, how do you actually begin? Without feeling totally overwhelmed, you really don't need a massive amount to start. Seriously. Start small, but start now. A systematic investment plan, an SIP. Fantastic way to go. It's just setting up a regular, automatic investment, maybe into mutual funds or index funds. Even something like a public provident fund, a PPF that's government-backed, safe, offers tax benefits. A great starting point. The message is just crystal clear. Don't wait for the perfect time. The best time was yesterday. The second best. Right now.
Precisely. And it's not just about piling up cash. It's about building the foundation for your long-term goals. Maybe that's buying a home, funding education, having a comfortable retirement without worrying. Investing early means your future self will seriously thank you. It's the clearest path to building long-term wealth.
Okay, moving on. Mistake number 4. Not having an emergency fund. Life just loves to throw curveballs, doesn't it? I remember a friend, job loss, then the washing machine died. All in the same month. A real double whammy. It's in those moments, sudden job loss, a medical issue, a car breakdown, that you realize how fragile things are without a safety net.
And that's exactly what an emergency fund is, your financial safety net. Absolutely indispensable. And the ripple effect of not having one is pretty severe. Our sources really highlighted this. Without that cushion, people end up borrowing money, maybe from family, or worse, putting it all on high-interest credit cards to cover emergencies. And that just completely derails any progress they were making, pulls them right back into those debt traps we talked about. It's a cycle. Avoidable, though.
Exactly. So building the safety net, it isn't just a nice idea, it's essential, non-negotiable for peace of mind.
Yeah.
So practically, how do you build one? Well, the aim is 3 to 6 months worth of your essential living expenses. Think about the absolute must-pays: rent or mortgage, food, utilities, minimum loan payments. Not the wants, just the needs. And where do you keep this money? Needs to be easy to get to, liquid. But, and this is crucial, totally separate from your everyday spending money, good options are like a dedicated high-yield savings account, maybe a liquid mutual fund, or even a fixed deposit, an FD, just somewhere safe, accessible, but not too tempting for impulse buys.
Right. And the benefit, it goes way beyond just the money. It's about emotional well-being.
Yeah.
Knowing you're prepared for those inevitable bumps in the road gives you this quiet confidence instead of constant anxiety. It protects your long-term goals. It's a real gift to yourself.
And finally, mistake number 5. One that's still so common, despite everything, ignoring financial education. It's a massive gap in our education system, isn't it? Almost criminal. We spend years learning calculus, history, whatever. But the basics of managing personal money, hardly taught. We learn how to earn it, but not really how to manage it, protect it, or make it grow.
Which raises a really key question, right? If you don't know how to manage something properly, how can you expect it to grow? Or even just hold its value? And the result of this lack of knowledge is clear. People make poor investment choices because they just don't understand. Or they fall for scams because they can't spot the red flags. Or they just let their cash sit there, losing value to inflation year after year. They might be great at earning, but they lack the skills to make that money truly work for them. It's like accepting financial ignorance, and that's incredibly costly over a lifetime.
Such a powerful point. And financial education, it's not a one-off thing, is it? It's an ongoing journey. But the good news, there are tons of ways to learn now, more than ever. Don't wait for someone else to teach you. Pick up some good books. Classics like Rich Dad, Poor Dad can really shift your mindset. The Psychology of Money, brilliant insights into how we think about money. Beyond books, follow reputable finance channels on YouTube, podcasts like this one, hopefully, good blogs. Commit to learning the basics. Budgeting, investing fundamentals like diversification, understanding taxes, how insurance works. It's not rocket science, but it does take effort, deliberate effort.
And that effort. It's incredibly empowering. Financial education is the key to making informed decisions, getting rid of uncertainty, taking real control of your financial future. It's about seeing the whole board, not just moving pieces randomly. Gives you confidence, helps you spot opportunities, build wealth intentionally, not just by luck.
Okay, now, as promised, that bonus tip. Something that can genuinely save you years of stress, and it's often overlooked, especially when you feel invincible in your 20s. Not getting proper insurance. That common thought, I'm young, I'm healthy, I don't need it yet, it's just an expense I could use for something else. I definitely thought that.
Yeah, and while that feeling is great, the reality is accidents, illnesses. They can happen to anyone, any age, without warning. None of us are immune. And here's the crucial bit. Getting health insurance when you're young has this powerful double benefit. First, it's usually way, way cheaper. Insurers see you as lower risk, so premiums are lower, much lower sometimes. Second, and this is absolutely critical, it's a shield. It protects your savings, protects them from being completely wiped out by unexpected massive medical bills. One major health event, an accident, surgery, serious illness, can easily cost thousands, tens of thousands. It can set you back years financially, decades even.
Absolutely. Think of it less like an expense, more like a foundational protection, a shield for the whole financial plan you're building. It's not just about covering costs. It's an investment in your long-term financial health, your peace of mind, making sure life's curveballs don't completely derail your future. So, quick recap then. For anyone in their 20s, or advising someone who is, 5 mistakes to really watch out for. 1, avoid that overspending, that lifestyle inflation creep. 2, stay clear of debt traps. Seriously. 3, start investing early, now. Compounding is your friend. 4, build that emergency fund. You'll thank yourself later. And 5, never stop learning about money. Commit to financial education. And please, don't forget that bonus tip. Get proper insurance, especially health insurance, while you're young.
Yeah, your 20s. They really are pivotal. They're not just for having fun, though. That's vital, too. But they are absolutely crucial for building that solid financial base for life. By dodging these common mistakes, putting these strategies into practice, you are setting yourself up for a future where, honestly, your older self in your 30s, 40s will look back and be incredibly grateful. This proactive approach, it changes everything, your options, your opportunities.
And maybe as you think about all this, don't just think about avoiding the bad stuff. Think about using this knowledge as your personal blueprint, a blueprint to define and then actually build the financial freedom you want. What does that look like for you? Is it travel, early retirement, funding a passion, just feeling secure? How will these ideas help you get there? Something to chew on until our next deep dive.